Let's get to our market panel. Ariel Investments Vice Chairman Charlie Bobrinskoy and BNY Investments Head of Investment Analysis Jake Jolly. Guys, welcome. Jake, you think from here that there's a relatively low risk of entering a bear market, but it sounds like you also think stocks are in a real shift now from worrying about the Fed to focusing on earnings growth if they're going to go higher?
We do, yeah. I think, the next few weeks are going to be a bit tricky for obvious reasons. There's going to be a lot to digest for this market. But looking into, as an investor looking into 2025, we still think this is a very favorable backdrop, right? We have an economy that's proven to be much more resilient than we all expected, especially after the growth scare that we went through at the end of July, early August. But now we're seeing a Fed that's cutting into a resilient economy. And historically, that's just a very positive backdrop. So while we think the next couple weeks and into the end of the year could be a little bit tricky, especially, the event risk as well as the labor market, I think is still, a critical data point that hasn't been settled. When we look to 2025, we're much more positive because we think that, the earnings follow through is likely to be pretty solid. Because we see growth remaining positive in 2025.
Well, that's encouraging. Charlie, I was just looking at Jim Paulson's newsletter before the show. He points out how poorly large cap value stocks have performed in this 2-year bull market, second worst of any of the 13 bull markets since 1949. I know how much you love value stocks. Should I think that's going to change?
Yeah, it's been a tough time for value on a relative basis. The absolute returns have been fine. I mean, my fund is up something like 18% year to date. So we're making money, but clearly not anywhere near what large cap growth is making. And we do believe that a lot of that can get fixed if we get worries about a recession behind us. I mean, we have some names here at Ariel like ADT, the security company, that had gone nowhere for years. They had a decent number today, and the stock was up 18% plus. So there are value names where the expectations are pretty low. You get a decent result from a quarterly profit point of view, and the stock can explode higher. You're not going to get that from some of the growth names that are priced fully with expectations of very good growth going forward.
Jake, the fact that the Fed is data dependent, and so far the data's been pretty solid, or at least Goldilocks. How likely now is it that you could see a Fed, if that continues, actually take a November cut off the table? And if so, how much does that matter to the stock market here?
I think it would matter a lot, but I don't think it's very likely. I think, we've certainly been hearing from the Fed speak a little bit more cautious. They're trying to kind of talk down and make sure that the market is not getting used to these 50 basis point cuts that we started with. But I think when you look at a read of the data, there's more concern on the labor market side than on the inflation side. Now, we have had 2 inflation prints that were hotter than expected. But when we look at those forecasts, I think the Fed is much more confident that trajectory is still towards 2%, even if it's slow and maybe a little bit bumpy. Whereas the Fed has been very clear that they want to support the labor market. They don't want to see further weakness. And if they're committed to that, they need to continue with this trend of lowering rates, right? Because we've already seen that in terms of Fed cut expectations, we went from 10 into the end of next year, which I think was way too extreme. Now we're looking at 5 to 6 cuts until the end of next year. I think that's much more reasonable, and it's in line with the Fed expectations. So in that perspective, I think the rates market looks a lot more reasonable now.
But Charlie, it does get to a key question for investors, and that is, yes, I realize yields took a little bit of a breather today, but you still have a 10-year Treasury yield at 4.2%. We've seen this run back up. And what is causing it? Is it a repricing of Fed policy, or is it something else?
It's the fact that the bonds tend to be where people go when they're worried. They are a flight to safety trade. When people were worried about a recession, they buy bonds and send yields lower. Now that people are feeling better about the economy, yields are going to go higher. There also, by the way, I think is a little bit of growing expectation of what inflation is going to be over the next 10 years. That number was probably 2.25. Now I'd probably put it up closer to 275, given some of the things we're hearing from our presidential candidates. So 420 is a hair above the long-term average, but not much. It's higher because people are not as afraid of the economy.